Hello, this is Corner Invest. Today I'll be talking about why the stock market is overvalued now in the US. So if you look at all the valuation metrics, we're basically at all-time highs now. Dividend yield at all-time lows. And then you have the market that has gone up 20% plus for 2 years in a row already. So is it now time for a US correction? Or is it time now for a crash? So if you compare the stock market now as compared to your year 2000 when we had the dot-com bubble, you have companies now that are trading in historical high valuations like back in the day. So you have Palantir now trading at a 400 PE, which is comparable to Cisco back in the day. And then you have all your quantum computing stocks rallying based on stories. And so if you look at the market right now, you have Bitcoin going up as well to all-time highs. Stocks in general are basically risk on now. So with that being said, with valuations at all-time highs, is it time for you to sell all your positions and just liquidate everything and just wait for the market to crash? So no, I'm not doing that because it is almost impossible for you to time the market. So if you currently have a lot of your US stocks in there already, I wouldn't think that selling is a good decision. Howard Marks was one of the super investors that timed the dot-com bubble. What he's saying now is, although US stock market valuations are extremely high, number one, it is not in bubble territory yet. And number two, it's almost impossible for you to time the market. More people lose money trying to time the market than actually just riding the wave out of it. So next, is the stock market deserving of a higher valuation now as compared to the past? So for me, I think the US stock market is overvalued, but multiples now are higher than back then because we have higher quality businesses right now with higher switching costs. In general, I still think the US stock market is overvalued, but the argument can also be made that we have higher quality businesses now. So for me, I'm not selling my US stocks, although I think they're overvalued. I'm just sitting out and not adding as much right now. Next one, let's talk about NVIDIA. So NVIDIA has been down around 15% since it released their earnings and is down around 25% from its all-time highs of $150 plus. And so is it time for you to start adding NVIDIA now? So for NVIDIA, the problem is they are a hardware company and they're trading at a $3 trillion valuation. So if you compare NVIDIA to all your different other Max 7s, and in my opinion, if NVIDIA doesn't have that, it doesn't really justify the $3 trillion valuation. Once it reaches that point, it cannot go higher anymore. Whereas for the consumer, it is limitless. Also, another thing for you to consider is we are on an AI capex uptrend for NVIDIA now. So normally when you want to buy this kind of companies, you want to buy it as it is going up from the bottom. But for NVIDIA, we're approaching the top soon. And you have geopolitical risk as well. So the AI trade war between your China as well as your US. So for me, if you're a long-term investor, then NVIDIA is an avoid now. But if you're trading the stock, maybe you could enter at a support level. And NVIDIA historically is currently trading at a discount relative to its history. So if you think this AI story can continue for the next 1-2 years, with that being said, let's talk about the best Max 7 to own right now. So for me, it's still the same one. It's still Google because although Google is not the highest quality Max 7 stock right now, it is the one that is trading at the cheapest valuation, meaning to say the risk to reward is the best of all the Max 7 stocks. But there are two other Max 7 stocks that I'm considering as well, Microsoft as well as Amazon. So for Microsoft, the story is extremely simple. All I need them to do is just for the AI capex spend to just materialize. So for Azure to continue growing at around a 15% growth, and for the other businesses as well to grow at around 10% growth. I think it's deserving of it. So if it can continue growing at around a 14-15% EPS growth over the next 5 years, I think we could see a 15% CAGR for Microsoft if it can hold the current valuation. Next stock that I'm looking at is also another cloud computing stock. It is Amazon. So for Amazon, if you look at their core businesses, they have a few things. So they have the retail side of things, they have their advertising portion as well, and then the one that is the most intriguing for me is their AWS business. So the AWS business is superior compared to Azure and Google Cloud. So let me lay out to you the competitive advantage for all these three different cloud providers, meaning to say they offer the best solutions when it comes to all this cloud providing software. And then you have Azure as well, which is sort of like the bundle deal. And then you have Google, which is the easiest to use as well as the cheapest. So in terms of quality, Amazon clearly is more superior compared to these other two cloud providers. And so if you look at Amazon's cloud business, it is currently at a 57% operating margin. It is currently at a 37% operating margin. And it is making up around 57% of Amazon's net income. And so if we can see a mid-teens growth for AWS for the next 5 years or so, I think this will be an extremely valuable portion of Amazon's business. Next one is Amazon's normal businesses. So they have the retail business, they have the online stores, they have the advertising business, the seller provided services as well as the subscription business. So for all these businesses over here, the margin on it is around a 5.7%, which is extremely terrible for any business. But if you look back just 1 year ago in 2023, it was around a 1%. So the story for Amazon is simple. It's just a story of margin expansion, which is what we're seeing over the past 1 or 2 years. And Andy Jassy, which is the CEO, has also said that they are moving more towards profitability rather than focusing too much on growth. So if Amazon can improve their margins, I would say it's undervalued today. Because if we compare their margins to other retail businesses, it is still extremely low compared to them. And so if Amazon can just increase their margin by a few percentage points here and there, which is also why I'm looking at Amazon stock today, as it's sort of like down 15% from its highs already. We have a Max 7 that is integral to everyone's life, trading at a 21 PE now. It's ridiculous, but this is how the market works, so take advantage of this dip.